Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. So in this edition of the podcast, I catch up with Marcus Phayre-Mudge, who is the long-serving manager, I think I can say, of TR Property, the listed property investment trust, which invests across Europe, primarily in other listed property companies. You put out some results quite recently, Marcus, and, well, tell us the highlights. It was a good period in terms of performance, and there's signs of improving sentiment in the commercial property market. Would that be a decent summary?
Yeah, absolutely. And in fact, the share price total return for the 6 months was 12.9%, which was essentially an NAV move of 10.9 against the benchmark of 9.3. So all those numbers are healthy and positive, but an important one, of course, is to try and keep our performance ahead of that of the benchmark, which we did a little bit. But essentially what the market is rewarding us with is a realization that we are now past peak rate, and that's very important. Having said that, it is worth reminding listeners that real estate, particularly commercial property, doesn't really price off the short end of the curve. Property companies borrow money. They do tend to have revolving credit facilities, but the vast majority of their leverage will be on a 3, 5, 7, 10 or even longer basis. So actually, it's not so much the shape of the curve that hasn't adjusted that much. It's partly a sentiment point, but that sentiment has then fed through into the lenders. So there are many more participants returning to debt markets than previously. You've got stability, therefore, in margin. And in fact, margins are coming down. So you've got stability and contraction as that market gets more competitive, whether you're borrowing bilateral in a syndicated situation or even in the public market, in the debt market. All of this is positive for the pricing of real estate.
Obviously, the point is that you can get better terms on your debt, but of course, you've got to have a positive outlook about the underlying assets as well to justify that. You've obviously increased your gearing recently. There's always hiccups along the way, though, isn't there? I mean, I don't know what impact does the UK budget, for example, had on the prospects for commercial property in the UK, which is obviously part of the area in which you invest.
Yeah, I mean, you're dead right. Markets just never move up in a straight line. There are always bumps in the road, and we're almost in the middle of one of those bumps now, because since our half-year results, which is to the end of September, we've had a very difficult October and November, essentially given back 2/3 of the gain that we made in the previous 6 months. And that has exactly been really all around geopolitical risk. The market fundamentals haven't changed. We still have low oversupply in lots of our key markets, and we'll come back to that a bit later. But it's just touching on the political situation, not only here in the UK, but also, we're talking on the 6th of December, and clearly that everything in France is immediate and raw. But of course, Germany also has its own problems with an election next year. But turning back to the UK, yes, from a business perspective, the budget has not been helpful. From an infrastructure and house building perspective, quite possibly we may well see improvement in both those areas, neither of which we're able to capture necessarily short-term exposure, nor are going to have a short-term response. I mean, we do have, at the margin, property companies that have excess land or land that they had hoped to get planning for, possibly for residential, and that will now probably be, in some cases, quite significantly accelerated, but that's slightly on the margin. But in the round, clearly the budget was, one might even argue, potentially stagflationary, which is obviously not what we want to hear. But while we're on the subject of the risk of these economies, particularly across Europe, when you compare us with the US, of a slowdown, I think it's worth just reminding investors that as somewhere to hide in the equity market, real estate, if the world or your market goes into a mild recession, property is quite a good place to hide, because corporates make less money, but they don't stop paying their rent, and they still press on with plans to, if they're already moving premises, etc. What's really nasty for real estate is when you get a very deep recession and companies actually go bust and you find yourself with excess space, etc. The reason that a mild recession or a brief dip is in some ways almost attractive is because generally the central banks react quite quickly. They realize that the cost of money, particularly short-term money, is too high. Base rates come down quite quickly as they try and re-energize the economy. particularly the consumer, who's invariably suddenly reeling from smaller wage increases or lack of job opportunities, etc., and just a general increase in the cost of living elsewhere. And the one way to supercharge that, of course, is to reduce the cost of mortgages.
So there's a sort of mixed picture there. I think in terms of valuations, if you just talk about valuations, if you look across the companies that you invest in, what's been happening? Are we actually beginning to see some change? It was a very marked period when we had a bifurcation between, or a trifurcation between different types of property, offices, retail, and so on, industrial. Are we beginning to see some change in the balance there between the sectors in terms of valuations and indeed potential performance?
Yes, absolutely. I think the first point to make is that the high-flying, supercharged logistics and industrial markets remain the sector du jour, but the rate of rental growth that we saw through the pandemic and in the sort of massive expansion of nearshoring and onshoring that we've seen in the last couple of years, that had to slow down. There has been the supply response, and that rate of rental growth has slowed. It's still positive, but that means that those shares that were trading reflecting really quite substantial growth prospects have come off. So we've seen that the industrial names, the likes of Segro, have clearly come significantly off their highs. To give you some idea, Segro is sort of 940, it's now 750. So a lot of that readjustment has been priced in. In terms of the office markets, absolutely, the message is one continuing and ongoing bifurcation. The numbers you need is kind of 2, 7, and 10. 2 being the vacancy rate on A-grade office space in the West End. I mean, it might be 3%, it jumps around. 7 is the number in sort of Midtown and drifting towards the city. 10 will be the city, and actually Docklands is probably more like 15. So the irony is that if you want 20,000 square feet of brand new EPC rated A, best in class space with outdoor terracing, etc. in the West End, you're going to pay a record rent. It'll be more than £150 per foot. Meanwhile, we jump on the Elizabeth line and head down to Canary Wharf. You can have as much as you want for 40 quid. So it is very much a local market. It's all about depending on where you want to be. And by the way, this bifurcation applies all over the world, and particularly in Europe. We remain quite long of central Paris offices, which may surprise listeners. But this is all to do with the fact that, as most people have been to Paris, they know how small the centre is, how hard it is to redevelop, and how there is a severe shortage of best-in-class space. So that's an example. The market that has shifted the most in the last sort of 12 months, or stabilised the most, has been retail. And again, here you've got retail warehousing, so those big boxes, edge of town, that terrace where you've got everything from B&M to B&Q to Pets at Home, etc., they are booming. And in fact, there is literally almost no vacancy in retail warehousing. And that's because it's a very simple piece of real estate to understand. Retailers like it. There's no service charge beyond cutting the grass because you haven't got common parts and big arcades to heat and cool and secure and lose and all the rest of it. And it's very affordable. And of course, it fits very neatly in a click and collect, click and return strategy, free parking, etc. So we're seeing good rental growth in those markets and yields compressing. In fact, yesterday there was a very large deal announced whereby a big private family office, Redevco, the Brenick-Meyer family behind CNA, have acquired £520 million worth of retail warehousing from Oxford Properties, who are one of the Canadian pension funds. So big deals being done there, lots of price discovery. And then in the shopping centre world, a realization that actually for the very dominant shopping centres, there is a price. Retailers do want to be there. They have right-sized, etc. And it's quite interesting to note that the likes of Next have been expanding in places like Bluewater. And Lord Wolfson isn't one for wasting his money or his shareholders' money. So, we look at that with a lot of interest. But those centres, the last deal bought with Land Securities buying out the other half of the Sir David Centre in Cardiff from Into, or the administrators to Into, and I think the running yield was a 9%. So you've seen a serious collapse in pricing over the last decade, but we genuinely think there is stability now. So we have this pretty clear message that valuations are bottoming out. Across Europe, it's a slightly different picture, where valuers tended not to adjust pricing down as fast as they have in the UK. We describe it as the UK tends to mark to market quite quickly, whereas European valuers tend to mark to model, i.e. it takes time to adjust their DCF. If there isn't a lot of valuation evidence, rather than saying, right, there's no evidence, the next step is a leg down, they tend to go across the V shape, as it were. But we are again beginning to see price discovery across European markets, and that's beginning to get reflected in pricing.
So this is quite a dynamic market. And I guess one of the issues has been the difference between what the stock market is valuing things at and what other participants in the property world can see as potential value. And so we've seen quite a lot of M&A and consolidation and so on, particularly affected the investment trust sector, of course, where the discounts became quite wide. Is that over now, or is there going to be more of that? If you say that the market is adjusting, does that mean that there's more or less opportunity for M&A and corporate activity from here?
That's a great question and highly topical, Jonathan. I think the answer simply is that when NAVs were still falling, the stock market required a very large discount, it always has, to an unknown number. It said, like, I'm happy to own this, but I need like a 30, 35, 40 discount. Now the NAVs are stabilizing, those discounts are closing fast, and we are back across our universe, probably at a 20 discount, which is still wider than the long-term average, which is closer to 10, 12. But of course, it's always about, is the NAV that you are discounting off, is it a real number? That's our one. And my message to listeners is very much that we do have plenty of price discovery and those numbers are real. So the M&A activity, I suspect, is going to continue, not because there's necessarily a lot of low-hanging fruit, which is, one might argue, some of the earlier transactions we've seen, but because it just makes huge commercial sense for consolidation to continue. The wealth management community, the underpinners of these registers, particularly on these externally managed vehicles, are themselves all consolidating busily. If you think about Tilney, Towery Law, Smith & Williamson all becoming Evelyn partners, you think about Schroders and CAVCAP, you think about Investec and Rathbones, etc., etc. And there's lots of it going on at the lower level as well. So these businesses, you went to them today and said, I'm going to have an IPO of a diversified externally managed UK REIT, and we're going to try and raise £300 million. They're going to say, well, that's just way too small. We really need something at 2 billion. So therefore, there does need to be an ongoing rationale for consolidation in the sector. And because not only is it attractive to the registers, it's also highly accretive. And if you look back at the takeover of Mackay Securities by Workspace, I think Mackay had 18 employees and Workspace took one of those. So it was able to remove all of that cost, as well as the listing and the auditing and all the rest of it, before it even started on adding any accretion through the portfolio consolidation. You're just taking out a load of costs. And I think that the externally managed REITs, of which there are still a few out there, also are in the middle now of sorting out, or the boards are realizing that there hasn't been enough alignment between the manager and the shareholders. And we've seen literally in the last month, Atrato, who are the manager of Supermarket Income REIT, announced that they are going to move to a market cap based fee, which we absolutely applaud, because if you take another one, Life Science REIT, also known as Labs, their share price is 35 pence and their last published NAV is 77. So the shareholders are eating 35 and the manager is being paid an ad valorem fee based off 77. So it doesn't make any sense. And my point to the boards when I speak to them is, if you are trading at a premium, I'll be delighted to pay you more than your old fee structure, because you've done a brilliant job and you're trading at a premium and shareholders are enjoying that premium rating. But if you're not, you need to be alongside shareholders and be aligned. And the other two pillars of good governance that we're looking for is what we have in TR Property, which is a 1-year rolling management contract. The boards need to be able to remove managers when they wish to, if they're underperforming. And then the other part, which we do have in the case of Supermarket Income REIT and Tritax, Big Box and others, where a decent chunk, in those instances, 25% of the fees are paid in shares. So you ensure alignment. Everybody is very focused then on not only the underlying portfolio, but how that is reflected in the share price. So we have no problem with externally managed vehicles. We just need to improve the alignment. But of course, where you do have these ad valorem based NAV fees, it does make it very accretive when these businesses come together. We have applauded London Metric, and we've been big holders in London Metric, who acquired TTPT, which the trust owned 10% of. which is an externally managed vehicle. And then subsequently, they obviously acquired LXI, swallowed LXI as well. And we inherited stock in LXI through the merger of LXI and Secure Income REIT. But to answer your question in a very long-winded way, is there more to go? Yes, there are a few out there. Others are choosing to go down the wind-up route. Obviously, Custodian REIT, the shareholders voted against the merger of Custodian and Aberdeen Property Income, and Aberdeen have gone down the wind-up route. They incentivize their manager in an accelerated fee basis, and so they promptly sold the entire API portfolio, apart from the forestry, to a private business, which was backed by Golden Trio, or Goldman Sachs backed business.
So I've just been looking through the performance of certainly the listed vehicles that I follow, including the investment trust. I looked down their performance back to the end of third quarter in last year. So that was when things had changed a little bit. Interest rates started to come down, or expectations that they would come down rather changed. And looking through those, interesting. I mean, at the top of the list are those trusts which have either been taken over or realized value in some other ways. And I'm including PRS REIT in that one at the moment. So Balanced Commercial Property Trust, Aberdeen Property Income, and so on. And then there's still quite a lot of them down the bottom, including Supermarket Income REIT, Custodian you mentioned, AEW, Value and Index Property Income Trust. They're all still negative share price returns over that period. You're up about 13%. So I'm just wondering how much of your performance is due to backing those takeovers, those realization opportunities, and whether that's compensated for the fact that the balance perhaps has not been delivering as much as it might have done. And these other trusts are still struggling with that issue.
The honest answer is the one that we weren't allowed to own was BCPT, because that is a sister fund inside the Columbia Threadneedle stable. So I did make the point to the board a year ago that I felt this was a very attractive, deeply discounted, well-managed, well-run trust, but clearly it had a very big shareholder. Aviva owned 26%, that there was sort of trouble at mill, as it were, but we weren't allowed to buy that one. Otherwise, I would have certainly have been involved in that. Tritax Eurobox, we were shareholders in, and we were pleased with the outturn there. This is the one where Brookfield have ended up acquiring and then subselling a whole lot of the assets to Segro, who'd previously put in an all-paper bid. They're now buying from Brookfield in cash. I feel that Brookfield are getting the right side of that particular trade. We had a little Spanish business called Arima, which owned Madrid office buildings. CBD did a very good job at repositioning those. And that was a long-standing management team who we had previously backed in a business called Axiari, which was acquired for cash by Colonial back in about 5 years ago. And that was taken out by a private REIT at a 25% premium to the undisturbed share price. So again, a classic case where the NAV was sort of €9, the share price was 680, and the takeout was 840, 8.4. So the fact of the matter is, Jonathan, you're dead right that the market continues in many respects to undervalue this little corner of the equity market, which is quite straightforward because the underlying assets in these companies can all be individually valued, and it is the sum of the parts. And if you leave them trading at big discount, they will get taken out. PRS REIT is worth mentioning. You mentioned it. We'd been in this at the beginning, and then we'd sold out because it was taking so long and such a difficult job to build those 5,400 individual single-family homes, which are now done. They did a very good job doing that, but the share price was going down and down because people were concerned about the relationship between the board and the manager and what the motivation of the manager was behind this. And in fact, we were buying the shares at the tail end of last year, and then they announced an extension to the management contract, which we felt was wholly unnecessary. Unbeknownst to me, I just stopped buying the shares because I thought it didn't tick any of my governance boxes, but actually other shareholders were taking serious umbrage with this situation. And we then saw the subsequent activism. So that was activism that in many cases we are there at the forefront of, but in that particular case, we weren't. That was other people. So it's good to be not alone in making sure that there is good governance. It's good there are other shareholders getting out there. And it's very much becoming a theme of the moment, which is great. And, the rest is history almost with PRS REIT. And sure enough, the share price has gone from 80 odd P to 107. So again, it's sort of why aren't these things trading up at the right price anyway? It's because they need to have the right structure. And what PRS has immediately done is reduce the notice period to 1 year so that if somebody does want to come along and acquire it, the contractor, which is the way of describing the manager, because they are only contractors, is not an impediment to the transaction. And then most recently, and really very importantly, another little REIT called Warehouse REIT, where the manager is the same manager but has two different companies, also manages labs. So I would expect the board of labs to also look very closely at what the board of Warehouse REIT are saying. The board of Warehouse REIT have just announced that they're going to be reviewing the management arrangements. The cynical side of me has said, well, they've put out this notice to try and calm the market and they'll attempt to kick the thing into long grass, but they absolutely won't be able to do that. The board will now be held to account because they have basically said, look, we appreciate that the current situation is non-viable, but if you can get your costs adjusted appropriately, the earnings will hopefully then cover the dividend and the whole thing can move forward. So it is a sensible thing to do. I'm not here just to bash management teams. I'm an external manager myself. It's to make sure you've got that alignment and that you are paying the right price for the service that's being provided.
And do you think this is a permanent, I wasn't going to use the word revolution, but this is a permanent change? Is it the days when boards perhaps could be criticised for being complacent in many cases, certainly when it comes to external management arrangements? Do you think those days are ever going to come back? Or is it just the case that we will gradually no longer see many externally managed investment trusts?
The honest answer is the world is not going backwards. There is now a high level of engagement between major shareholders and boards, and governance is at the top of everybody's agenda, and that's quite right. I think there is absolutely a home for externally managed vehicles. There's nothing wrong with them, and in some cases better, because it allows your management team to suck in skills from other businesses that they also manage. But it's just a question of alignment and being sure that at the end of the day, we want our management teams to make money, as long as that means that they've made money for shareholders first and foremost. So it's just an alignment which should have always been in place. But when a lot of these externally managed vehicles were created, they were created in an era of virtually zero interest rates. Wealth managers quite rightly put their money into these vehicles because they were promised really quite healthy dividends, 4-5% dividend yield and earnings yield, based on the fact that these guys were buying assets at 6% and borrowing money at 2%, and therefore they could take a very nice fee out of the structure and still deliver the returns that were needed to shareholders. That game is well and truly over. We may have gone past peak interest rates, but we're certainly not going back to the days of 1.5%, 2%. So now these businesses cannot just buy and hold assets. They need to be doing the right thing, the right asset management in these portfolios. And some of them are, and some of them aren't. And I think everybody is aware that they've got to improve. So it's not only governance, but also it's professionalizing the structures. And the problem is, if you are only running 500-600 million of assets with gearing of 30%, and then you're trading at a 20 discount, so your market cap is circa 250, this is all relatively small beer and the efficiencies are not there. You need to be part of a bigger animal. But please, it's worth saying to listeners that this is a little part of one part of it. It only occurs in the UK, these externally managed structures. The UK is only about 30% now of our portfolio in equity terms. And then within that, by number, about half of them are externally managed. But of course, you've got Tritax is the big one, particularly following its takeover of UKCM. And then you get a long tail of much smaller ones. And our big diversified exposure in the UK is through London Metric and Picton Property, both of which are internally managed. Although recently I have taken just over a 3% position in S-REIT, the Schroders REIT, where the manager, Nick Montgomery, has just been promoted to global head of global real estate at Schroders. A lot of globals in there. And therefore, it's interesting to see who takes over, because the manager of these externally managed REITs is eventually a de facto CEO. So, you suddenly got a business where, well, hold on, we know this chap's going to do another job. So what's going to happen? So things like that are always on our minds. Quite a lot of change at board level. We've seen quite a lot of turnover with one or two chairmen being offered other roles. So you're always very keen to see who stepped into that role. And I was asked the other day, Marcus, you've been doing this job for 25 years. What has really, really changed? There are many things that have changed, obviously, but one that's worth just mentioning is that for the first 10 years of my career, I hardly spoke to a chair. It was all about the management structure. It was all about the chief exec, the CFO, the CIO, chief operating officer, etc. But the last decade has been much more about engagement with boards. And, there's a slide in our presentation that I put out on the interims, it's all on the website, etc., which does show the M&A activity and where TR Props has been involved. And we are quite an unusual animal here because being a closed-ended permanent capital vehicle, I can afford to take some quite significant bets in small companies where I suffer the price, as it were, or the discount of being tied up in an illiquid animal. But if you back the management team or you back the board and you can help evolve the business either through consolidation, privatization, or a growth strategy, then Turpit shareholders have been rewarded. But it is only one leg of our stool, Jonathan. And yes, it has always been helpful. We've never been in an M&A situation that's been unhelpful, but there are situations where we end up holding positions for a long time for them to come to fruition. And one of those worth mentioning is Phoenix Spree Deutschland, which you and I have talked about in the past, which is a business that's externally managed. It owns a lot of very nice flats in Berlin. Berlin is a great city. And the secret with this particular business is that it has an unusual series of bits of paper that allow it to, when they can get a tenant out of a flat, in the case of almost 3/4 of those flats, they're not forced to put a new regulated tenant in there. They can actually sell the flat on a long leasehold basis, so what we call condominialization, for want of a better word. But it's been a long, slow process. The chairman there is excellent, and we have reduced the fee that's payable, incentivized management to begin that process of capitalizing, so doing more of these selling of apartments. And that will prove to be a positive, but it's taken a long time. Our average in price, unfortunately, is about where the share price is today. So it's not like everything we touch turns to gold. These things do take time. But if you believe in the underlying assets, and to give you some idea, if you have a regulated tenant at one of these flats and they move out and you are able to sell it in the open market with vacant possession, you are receiving about a 30% uplift to the previous rent because those rents are regulated, so they're below market. Now, what that means is people don't move out very often, but they're just through a fluxion of time, you do end up getting flats back. And then, of course, the debt refinancing, the cost of money is coming back down. And that's very important for German residential because the yields are quite low. So it's very sensitive to changes in base rate.
And presumably also changes in the regulation, because it was not that long ago that actually they allowed this process to happen, I think, removing the restrictions on conversions. You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous, no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results, and performance data from the investment trust sector, with links to the relevant stock exchange announcements, and many other regular features, including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favorite funds. Never miss a thing that might affect your portfolio. So sign up today at money-makers.co. And thank you for listening. Just before we talk one more thing about the trust itself, I just wanted to ask you generally about discounts that remain. And I'm still talking about the UK sector here, obviously, because that's of perhaps primary interest to our listeners here. They're still pretty wide in a lot of cases, aren't they? I mean, your discount is exceptional in terms because you do something different to everybody else. It's come in a bit, and it's about 8%, I think, now. But there's still a lot of trusts out there which are on 25, 30, 35 and so on, some of the specialist ones. Is that sustainable?
No, absolutely. If we were having this conversation 18 months ago, we would have talked all about the liability side of the balance sheet. It was all about who's got what refi, where, who's going to, has been borrowing money at 2 and now they're going to have to pay 5.5, etc. And valuations were just still in unknown territory. We're not asset values. We're now in the world where we have that stability in the underlying market. And yet we still, to your point, have this persistence of these large discounts. So the trust gearing today live is about 14%. And bear in mind that our maximum is kind of 20%. And bear in mind that at our most bearish, which was Q2 2008, so the quarter before Lehman's went bust, we were 20% cash. So that's our kind of spread, as it were. If any of the listeners ever see me in the street and they're cycling past and they just shout, "What's the number?" You just need to ask, you're between -20 and +20. Now, today we're +14. So you'll know that we are, to be quite blunt, as optimistic as we've ever been. Plus our physical property exposure got down to 3.8%. And we'll talk about that in a moment. So I am very optimistic about the fact that the equity market is offering great value, particularly after the pullback we've seen in the last couple of months. I do think there will be more M&A. I think you have to be careful not to buy these names just because they're very cheap. So we don't own labs. We don't own regional REIT, even though that business has restructured and it was a poster child of poor governance, to be honest. And it ended up, for listeners who are not familiar with this company, it IPO'd at £1 a whole bunch of years ago, had external management. It over-distributed on dividend. It had a retail bond which had to be paid back, and it ended up being recapitalized at 10 pence or 12 pence per share by a very clever chap, Steve Morgan, who owns Redrow and involved in a hedge fund called Tosca. So, that was a classic sort of car crash. Am I in that now? No, not at all. I don't believe in B and C location regional offices for all the obvious reasons we've talked about. But businesses that have something like Supermarket Income REIT, where, the share price is now 70 odd pence, we've got an earnings yield of well into the 8s. Yes, it has a debt cost that is going to go up over the next few years, but it's got a great opportunity within its 56 supermarkets that are all on FRI leases and a chance to hopefully asset manage with some of its big grocery tenants. So to me, that's a very, very fair value. The healthcare names have been hammered, again, because they're seen as ex-growth, and they are fairly ex-growth at the moment, but a lot of that is now in the share price. Again, with Assura, we own PHP, not Assura. But if we do think we're going into a bit of an economic slowdown, you want to look at the most defensive income streams. You want to look at those with the best credit risk, and healthcare falls into that camp. We do tend to prefer our European healthcare, I hasten to add, for other reasons. But something like the grocers, Sainsbury's and Tesco's, are going to continue to be with us, whether we're in recession or in boom time. Beds of all shapes and forms. So Unite student accommodation, we have lots of. iRes, which is a Dublin residential owner of flats. Again, you have rent controls in Dublin now, but I'm being paid 4.5% and trading at a 35, 40 discount. And I think that the next government is going to have to move rent up a bit, allow rent to grow, because otherwise no one's going to build any more flats, which is exactly the problem that the Germans have. If you control rent to the benefit of the incumbent tenant, developer is going to say, well, I'll never sell this investment because I'm only getting an inflation minus rental growth number. You're just not going to get any new apartments. So that's something that we've looked at. The same with, there's a very bombed out stock called Kojamo that owns flats in Helsinki. Again, we're buying these at way below replacement value because the stock market just doesn't like it. So I'm happy with that value trade where I'm confident that the income is still going to be paid. The companies are not going to go bust. I'd be much more nervous possibly about hospitality. I wouldn't want to own a lot of bars or nightclubs right now because the UK consumer may well be tightening their belts next year. Just the cost of living continues to go up, etc. So again, looking always at that credit risk.
So let's talk about your trust and just talk about the physical first of all. As you say, your physical exposure has gone down to about 3%, I think, which is a record low. You always had some, but you have recently bought a couple of new things in the physical space. And why that?
The reason we went down to 3.5% is because we sold our largest asset, the Colonnades in Bayswater, which was a fantastic journey. And I would encourage investors to have a look at the website and have a look at the slides on there. Essentially, that was a point in time, which was March. And in fact, it was very fortuitous. We then invested that money in the stock market and enjoyed the ride from April up until September, where we recycled roughly 20 of that 33 into an industrial estate in Bicester and a single asset in Northampton. Now, we're collecting a kind of 6% net initial yield on day one, but actually with quite a lot of reversion. The reversionary yield, where we think we can move rent up to the market rent, will mean that it will yield about 8% when we get there. Now, that requires some asset management. We actually bought Bicester from a defined benefit pension scheme, which was essentially selling its book to an insurer, and the insurer said, that's fine, we'll take all your equities, we'll take all your bonds, we'll give you a haircut on your private equity, but we don't want the real estate. So, and you're seeing quite a lot of this, so this in a way was we knew that the seller wanted to sell, so that we felt quite comfortable about the price. It was a competitive situation. I'm not pretending that we bought this at a lucky buy price or anything like that, but we're very happy with the asset. We think Bicester in that Oxford-Cambridge arc, there's a huge growth in automotive all around the back of F1, etc., in that Northamptonshire patch. And we know that no one's going to be able to build new units off the capital value that we bought this estate off. So we're quite pleased about that. I am often asked, well, Marcus, even now you're at 5.5% physical, what would you like it to be? And the answer is probably closer to 10. But we do have to remember that it is an off-benchmark position. My mandate that I'm measured against is 100% equities. So why bother with real estate? And just to rehearse that, and apologies for those listeners who've heard me say about this before, but there's three clear reasons. One, we like to make money out of it. Two, it helps us with earnings and with income. But almost crucially, it allows us to be consistently in the market. Brokers bring us deals, we might buy, we like to look at it, and we do get a lot of price discovery from deals that aren't necessarily reported in the press, and that's very useful color for valuation. And then finally, we like companies that we invest in and our investors to know that we are practitioners. I have a real estate background, a surveyor by training. I started my career at Knight Frank and Rutley in 1990. That just shows how damn old I am. But anyway, George Gay has been with me now for 19 years. We've had various other surveyors in the team. Currently, Hannah joined us from British Land a couple of years ago. And we like to be able to prove to companies that we know what we're doing as well. And I think investors should take comfort in that we're not just backseat drivers, as it were, of listed REITs. We actually do roll up our sleeves. And it also means we know how hard it is to get planning, how expensive groundwater surveys are, or dealing with flood risk, or, tenant risk, etc., and how much money you can make by just doing the simple things cleverly and spotting management teams that know what they're doing. I mean, it was a bittersweet moment when 18 months ago, Blackstone acquired Industrial REIT, which we own 12% of, at a 35% premium to the undisturbed share price. It was bittersweet because it was great to have that massive pop in value terms from us. But we had identified a very clever management team who had found a way of essentially digitizing quickly the process of management of highly management intensive industrial estates. You can imagine an industrial estate with 60 or 70 units, each one a couple of thousand square feet. That's so many lease events every year, very technical, and the operating margins were very poor for many, many decades. And this company developed a really good platform. And so when people say, why did Blackstone pay such a huge amount of money for this company? The answer is it wanted the platform. And it then put together its assets that it bought when it bought St. Modwyn and when it bought Handstein, two other listed companies, all together in a massive private business called Indorent, run by the chap who was the chief executive of Industrial REIT. So we pride ourselves on picking management because, Jonathan, at the end of the day, a very small number of brains can run a very large amount of property. And when people say, Marcus, how have you managed to be reasonably consistent and beat your benchmark 12 years out of the last 13? Oh, I managed to drop that one in. An element of this is identifying people. So today, if you say, well, okay, give me your smartest manager, well, that's very easy. That's Andrew Jones at London Metric. He does a very good job, and he has now become almost a consolidator, and he's been in the press saying that he wants to do more. So when you ask about, do I think that other things are going to happen? I've absolutely no idea what it'll be, but I can't see him telling journalists that he wants to acquire more companies and then not do it. Now, he might acquire a private company and issue paper. He might acquire from a pension fund. I've no idea, but he also might acquire another listed vehicle. But M&A is a very sexy subject. Everyone likes to talk about it, etc. But underneath all of this, it's making sure that we continue to buy businesses which are trading at well below their replacement cost, well below their intrinsic value, and just do what we can to help them market themselves, improve themselves, do the right thing, and if necessary, become part of something bigger.
I was wondering when you were bringing the 12 out of 13 years, but anyway, well done.
It'll probably go the wrong way from now on. So please, the past is no guide to the future, Jonathan. And I would say that as we stand today, we're a little bit ahead of the benchmark, but not enough for my liking. So we're all hands to the pump.
Bit of humility, of course. The final question then, TR Property pays a dividend. The yield is currently, I think, pushing towards 5%, all very nice, but it's not covered at the moment, I think. That's fair to say. And when can you get it back to being covered? Obviously, you've increased your gearing, you're sort of ramping up, but the dividend is important to a number of investors as well. So what can you tell us about that?
Absolutely. Well, the first point to make is that TR originally stood for Touche Remnant, as you remember, the fund management business that was acquired by Henderson in the 80s, and there were lots of investment trusts with the prefix TR. We then moved to Thames River Capital in 2004, and the trust followed us. That was nice and easy. We could pretend that the TR stood for Thames River. And now, post the acquisition by the various corporate changes, we now find ourselves part of Columbia. We say it stands for total return. And that's an important or trite point, is that dividend is a crucial part of what we do. And the board had steadily, quite rightly, over the years, of the good years, we built reserves up. And our reserves 2 years ago totaled more than 1 full year of dividend payout. So we were excess of 14 pence. And that's because when the times come when the dividend is uncovered, because in this case, interest rates move very dramatically, we had quite a lot of companies who went into an impaired state and needed to rebuild their balance sheets. And you initially start by stopping paying shareholders dividends, and then you start to bring that back slowly. We, of course, are now still feeling the effects of that. So we were uncovered for the year to March 24. You can look at our NAV capital only and our NAV with income each day, so you could work out. So I'm not telling you anything that isn't public information, that when you look at it clearly, given where our earnings are today, we'd have to be pretty heroic to get to March 25 and be covered then. So, the board are very aware of this, and we are messaging to shareholders, we will be utilizing some of our reserves again, but for the outlook for 26 and 27 is much stronger. Now, I'm not making a forecast. A lot of this depends on the price of money. A lot of this depends on the rate of indexation and inflation, because, of course, in Europe, all of our rents are index linked, but we have a path. We're very aware that we need to get back to coverage, but we make no apologies for continuing to pay a mildly progressive dividend because we do have these reserves. And that was very much, when you look back, our payout ratio was deliberately 94, 95, 96% for many years as we built that up. I couldn't tell you 3 years ago, or certainly not in the beginning of 2020, that we would have the pandemic and then we would have the inflation and the massive. We just like to have those reserves. And now we are utilizing some of them, not all of them, I hasten to add. And we do have a path to returning to dividend coverage. I just won't give you a forecast here and now.
Okay, well, on that note, I think that brings us to the end. Thank you, Marcus, as always, for talking to us. And, well, I think regulars, as always, find your comments interesting and you're never afraid to answer the question.
Will fool me, but Jonathan, thank you very much. It's been a pleasure to talk to you, as always.
Not at all. So that was Marcus Phayre-Mudge, the manager of TR Property.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.